All right, it was a big week. On Tuesday, we had the CPI report came out. Big news there, and then that was followed up on Wednesday with the Fed meeting with their rate hike. So I'm going to explain a little bit about what happened on those 2 days, so stay tuned if you want to learn more. Hey everybody, this is Brad Decater with the Decater Home Team. I'm not an economist, just a real estate guy, but I wanted to tell you guys a little bit more about what I learned, at least in researching the CPI rating and also the Fed meeting on Wednesday. All right, so let's start with the CPI report that came out. So the first thing is that it was better than expected. The CPI report is 7.1, and that's coming off of 7.6. A lot of the main economists and kind of experts in the field, they assumed that it was going to be at about 7.3, so we expected it to be good news and be coming down from the year-over-year average, but it actually turned out to be even better than they expected at 7.1. So that's definitely very good news, makes us kind of hopeful about the future and that the Fed's rate hikes are actually working and inflation is coming down. When you look in detail at the actual CPI report, it's pretty interesting to look at the different sectors. So food and energy are still pretty high at 10 and 13%, so very, very high for year-over-year averages, and shelter is right at that 7.1 mark. But for the most part, it was all good news. Even on month-over-month statistics, a lot of things went down. In fact, the majority of everything went down. So food, gas, energy in general, airline tickets, used cars, they all went down month over month. But the CPI, it looks at the year-over-year average, so of course it's going to be not negative or anything like that. We're looking at a last year from last year to this year, but still it did come down year-over-year, so it is good news. So one other point when it comes to the CPI rating is when you look at core inflation. So the Fed, they care a lot about the core inflation because take out the food and the energy part, that's kind of more important to the Fed because those numbers are a little bit more volatile. And when you take that out, it looks at it's about 6%, which is much, much better than obviously 7.1%, and it should be even getting better as we move towards next year. The last point I have before we move on to the Fed's announcement about the CPI rating is the shelter. So shelter is still at 7.1%, which is of course very high. But the thing about shelter is I watched a whole long video about this, about how they actually calculate shelter. And it's pretty inaccurate just in general, the way that they report the rents and the housing prices and everything. So I won't get into it, it's a whole nother video. But basically, this is what we call a lag measure. So the shelter sector in the CPI report, it just isn't going to come to fruition for another 6 months or so. So most experts think that what has been happening now in the real estate market, both with rentals and with home prices, we're really not going to see those effects in the actual CPI report until probably middle of next year. So obviously everyone watching this, if you're in my market, you know that real estate has been affected by what's going on. Prices are down, and it's just a totally different market than it was, but that's not really being reflected in current time in the actual CPI report. So because that's a lag measure, most of the experts think that we're going to see that come down significantly when we come around towards maybe the end of spring or early summer next year. Now this is a super important point to make because shelter makes out about 30% of the CPI rating in general. Core CPI rating and the overall CPI both have shelter in them, and shelter is such a massive part that when that lag measure kind of comes into play, I think it's going to bring down the overall averages and the actual CPI rating significantly pretty quickly when we get to the year-over-year averages there in next summer. So that's a pretty good summary on the CPI rating. So things are going in the right direction, which is good, which kind of leads me into what happened on Wednesday, which is the Fed's announcement. So previously the Fed's been raising interest rates pretty significantly at 0.75 most of the time in the last few months. At this meeting, it was a little bit softer at 0.5, but it wasn't all good news. The Fed did have a few things to say about their future plans and what they're thinking inflation is going to do and how they're going to react to that. One of the main things that was kind of a downside of their meeting was that they decided to actually increase their benchmark from 4.6 to 5.1%. So in other words, the Fed's going to continue to raise the rates until they get to their target of 5.1, pending different data, and they'll obviously react to the market and what's going on, but they're going to keep doing what they're doing until they get what they want, which is inflation coming down. They have a 2% target for inflation. Right now we're at 7.1, so obviously we have a long way to go. So the main takeaway from the actual Fed meeting, the parts that I watched from Jerome Powell, is that the CPI rating was definitely very encouraging. He was happy, to say the least, that this was actually happening and kind of what they're doing is working. So very optimistic, but he has to be careful, of course. He's not going to say that everything's fine and dandy and that it's all over with, because at that point, everyone would come back to spending money again. And if that happens, inflation is going to go up again. So I think he is trying to create a really good balance where he's saying, hey, things are going in the right direction, but we also have a long way to go ahead of us. That way people aren't, free spending everything that they need, that they can, because they think that he gave us really good news and that this is, the recession's over and all that stuff. So he's trying to kind of walk a line and balance it so that people are still a little bit fearful and we don't spend all of our money, because if that happens, then the inflation goes up. Another thing that I picked up on from Jerome Powell is that he seems to be a little bit more flexible in how they're going to maneuver, next year. So about 2 meetings ago, he was super bullish and just, no matter what, we're getting inflation down. I would rather over tighten and then print money if we need to. Like, we have to just go really hard with the rate hikes to then get inflation down, get into a recession, and kind of normalize this market. That has kind of shifted, at least in his demeanor and the way he's speaking about it. He's saying, we're very aware of over tightening, and kind of pending what evidence is going to come out, we can kind of adjust as needed. But they definitely still are going to raise interest rates, it looks like, the federal fund rate. But it looks like, based on this conversation or this meeting, that he's going to do it a little bit slower, probably a little bit softer, and we'll probably get to stop a little bit sooner than was planned. So again, I'm not an economist, but what most of the experts are saying, and the people that I trust, and so therefore that's kind of what I believe, is that we are going to see another 0.5, maybe it goes down to 0.25 rate hike here early next year. I think February is the next meeting, and another 0.5 or potentially 0.25 in the March area. But based on what everyone's thinking with the CPI rating and seeing that we are seeing progress, and also because interest rates are going to be continuing to go up the next few months or the next quarter, with all those factors in place, we think that, or they think that, we'll probably be able to stop the federal fund rate increases around that end of springtime, like maybe May. So at that point, it's going to be hard to predict what happens. They could just decide to stay around that level. So maybe we're at a little bit in the high 4s for the federal fund rate. They can kind of coast at that to see how the economy reacts, or maybe it's already done it's taken its course and done its job, and maybe the CPI rating and inflation is already down to their target that quickly. If that's the case, maybe they decide that they can go ahead and lower interest rates at that time. So not sure how long it's going to last. But it seems pretty clear that as far as projections go, which we can't predict the future, but what all the experts are saying is that it's going to be a little bit slower pace federal fund rate hike in the first quarter of next year. And then hopefully they'll be able to stop that rate hike somewhere in the end of spring, summertime. After that, they may be able to actually reduce them again. So what does this mean for mortgage rates? Because remember, the federal fund rate is not the actual 30-year fixed mortgage rates. They are different. These are tied to bonds, 10-year yields. The federal fund rate is short-term money and bank-to-bank loans, and it more impacts the big businesses and corporations and banks. So as far as the mortgage rates and what we can expect for buyers and sellers of real estate, is I think that we might trickle up a little bit. So keep in mind that rates have gone from 7 to back down to 6. So they went from 3% in the beginning of the year all the way to 7% very quickly. Then we saw a little bit of a recovery down to about 6%. So what I'm projecting, just based on my lenders and everyone that I talk to, is that they're going to kind of hover and kind of be a little bit wishy-washy and potentially go up a little bit, I'm thinking, in the first quarter of this next year. So maybe in the mid-6s potentially, or around 6. I don't think we'll go above 7 at any point again. And then once we have a little bit better buyer sentiment and the CPI rating comes down, so maybe the end of first quarter, there's some really good indications that, hey, what's happening is working and we're going to be able to get out of this soon. Once that change and real estate prices are going to be lower, of course, than they were a year ago, and then people have hope at the same time that things are about to recover, that's when I think things are going to change, and they're going to change pretty quickly. Because when the buyer sentiment comes back and people are more excited that prices are going to go up again, we're thinking like, hey, we might be at the bottom of the market right now. I think that some buyers are going to be coming out of the woodworks at that point. Although interest rates, I don't think will have caught up yet. So because of that, it's going to happen fast. We're going to have buyers come back to the market, and then I think interest rates will then slowly come down from there. And then we're going to have another, pretty significantly appreciating market, getting us back to where the values maybe used to be. So long story short, I think that we still have some work to do ahead of us. Fed is going to continue to raise interest rates. However, I do think that is what they're doing is working, and that the CPI and inflation is going to be slowly coming down. And the more evidence we see of this, the more likely it is that they can get their goal, which is going to be a soft landing, not getting into a huge recession. So if we see what they're doing is working, then they can probably soften up, and this might be over, faster than we expected. But all that is to be seen. So we'll find out how it goes. As far as real estate, just make sure to keep watching my videos. We'll do real estate market updates every single month to keep you guys informed about what's going on with the interest rates, inventory, housing prices, and all that stuff here locally in King County.